Disclaimer. This AI-generated podcast is for general information only and does not constitute financial or legal advice. Please consult a qualified professional.
Welcome to the Luxembourg Fundcast. Produced by Bertrand Mariot, a regulatory lawyer qualified as avocat à la cour in Luxembourg and Paris, this show brings you reliable insights on Luxembourg regulations sourced from curated official references. This episode is current as of 15 March 2026.
Thank you. It's great to be here to unpack this.
So, imagine managing billions in private debt, only to realize the foundational structure of your internal lending is, well, suddenly legally invalid under a brand new law. You've got the capital, you've got the strategy, but your structural blueprint is obsolete. Today, we are diving into a regulatory shift that's truly rewriting the playbook for alternative investments.
Right. It is a profound structural shift for the market. Exactly. We are unpacking the new Luxembourg law of 3 March 2026, which transposes the European Union's AIFMD2 loan origination framework directly into national law. And the reason we're doing this deep dive right now is simply the sheer operational weight of these rules. I mean, to give you a sense of the scale, if you look at the 2025 ALFI and KPMG Private Debt Fund survey, there was an average growth in assets under management of 24.7% between December 2023 and December 2024.
Which is just staggering growth for a single 12-month window. And, when capital moves that quickly, the legal architecture supporting it has to be absolutely airtight.
Yeah, which brings us to the structural preferences of that capital. Reserved Alternative Investment Funds, or RAIFs, now represent 64% of Luxembourg debt fund structures. Specialized Investment Funds, or SIF, sit at 29%. And meanwhile, among indirectly supervised vehicles, special limited partnerships make up an overwhelming 80%.
Right, which shows immense market flexibility.
It does. But with that flexibility comes a critical need for a statutory anchor. For alternative investment fund managers, or AIFMs, as well as boards and transaction teams, this new law is that anchor.
That's really the perfect way to contextualize it. It's the foundation upon which all of that capital must now be governed. The flexibility remains, certainly, but the guardrails are now codified in stone.
Right. And because the market is moving so rapidly, if you're listening to this right now and your daily reality involves fund governance or, corporate secretarial tasks or transaction structuring, there are 3 immediate bottom lines you need to absorb.
Absolutely. The practical takeaways are critical here.
First, you can no longer assume that every intercompany loan qualifies legally as a shareholder loan. The label alone just doesn't protect you anymore. Each instrument must survive a strict statutory test.
Yeah, that is a fundamental reality check for transaction teams.
Yeah.
You really cannot just place the phrase shareholder loan on a term sheet and call it a day. The mechanics have to mirror the legal text perfectly.
Which leads right into the second takeaway. Project finance and shareholder lending serve entirely different functions in the capital stack. Because of that, they require completely distinct governance, documentation, and approval logic. You really cannot conflate the two.
No, you can't. They operate on completely different risk premises.
Exactly. And third, while this new framework is highly permissive, it expressly allows loan origination, it is also strictly disciplined. The European Union is allowing this, but they're imposing hard rules on concentration, leverage, retention, and liquidity.
Right. If we look at the underlying rationale, the European Union has recognized loan origination by alternative investment funds, or AIFs, as a completely legitimate essential financing channel.
Right. They aren't trying to shut it down.
Not at all. But to prevent systemic risk, they've engineered proportionate safeguards. They want the capital flowing, sure, but they want investor protection and financial stability guaranteed at the same time.
So, to successfully apply these takeaways, we really need to understand the core structural mechanisms. Is it accurate to think of the old system as a well-understood but unwritten gentleman's agreement with the regulator, whereas this new law is the formal, unbending architectural blueprint?
I think that captures the transition beautifully. The core change here is not that Luxembourg suddenly permits lending out of nowhere. That permission already existed in the supervisory practice of the Commission de Surveillance du Secteur Financier, or the CSSF.
Right. The activity itself was already happening every day in the market.
Exactly. Historically, both loan origination and loan participation were permissible in principle, provided the fund had the right governance and risk management in place. The paradigm shift is that these permissions now sit firmly in statute.
So it's formalized.
Yes. We've moved from a practiced understanding to formal law, equipped with rigidly defined categories. For anyone operating an AIF or acting as an AIFM, you are no longer negotiating with supervisory expectations. You are complying with specific legal definitions.
Let's break those definitions down then, because I feel like this is where teams are going to find themselves in trouble. Let's start with the shareholder loan. We mentioned that not every intercompany loan makes the cut. So what is the actual threshold?
Well, under the directive, a shareholder loan has a highly specific mathematical and structural definition. It is a loan granted by an AIF to an undertaking in which it holds, directly or indirectly, at least 5% of the capital or voting rights.
Okay, so there is a strict numerical floor, 5%. But it's not just about the equity stake, is it?
No, and this is the critical part. The condition attached to it is that the loan cannot be sold independently of the capital instruments held in that same undertaking. The debt and the equity stake are legally, intrinsically intertwined.
Oh, wow. So if your loan doesn't meet both the 5% threshold and that non-separability requirement, it's simply not a shareholder loan in the eyes of this law.
That's correct. And that dramatically changes how transaction teams need to view internal fund-to-holdco lending.
It really does.
Yeah.
And if we look at the broader capital stack, this contrasts very sharply with project finance debt, doesn't it?
Radically so. When you look at an intercompany or a shareholder loan, it usually sits within the sponsor, the fund, the holding company, or the project chain. It's fundamentally part of the sponsor-side funding mix.
Right.
Project finance debt, however, sits at the level of the project's special purpose vehicle.
And the recourse there is entirely different.
Precisely. According to World Bank materials regarding these structures, lenders in project finance have limited recourse. They look primarily to the cash flows and assets of the special purpose vehicle itself to service the debt, rather than looking up the chain to the balance sheet of the equity investors.
Which means the risk profile is different, and therefore the governance and approvals must be completely separate. So now that we have the blueprint and the definitions, how does a transaction team actually build this structure without running afoul of the new law?
It's a great question.
Let's imagine you are a Luxembourg infrastructure sponsor. You want a fund vehicle that can inject equity, advance shareholder loans through the holding chain, and still accommodate senior project debt at the special purpose vehicle level. You need speed, and you need bankability. Where does that conversation even begin?
Well, the very first conversation has to be about classification and strategy. Before any execution happens, before any documents are drafted, you really must classify the strategy correctly. You have to test every single proposed internal loan against that statutory shareholder loan definition we just outlined.
Right, checking that 5% and the non-separability.
Exactly. And at the same time, you must determine if the strategy classifies the vehicle itself as a loan originating AIF under the law, or if it is merely acquiring existing loan exposures on the secondary market.
Because originating a loan is what triggers the full weight of this new framework. So assuming you are originating and your classification is locked in, how do you handle the paperwork?
This is where governance teams really prove their value. It's all about the alignment of documentation. Your constitutive documents, your offering document, your internal credit policy, your approvals matrix, and the final transaction documents must all perfectly describe the identical financing model.
So essentially, if your pitch deck promises one kind of flexibility to investors, but your internal credit policy dictates another, and your term sheet does something else entirely, you are creating a massive legal liability from day one.
That is the exact scenario regulators are looking to avoid. You cannot have a mismatch between what the fund is legally permitted to do and what the actual financing mechanics require on the ground.
Right. So how does the choice of the fund vehicle help alleviate that friction? I hear a lot about the RAIF being utilized for these specific strategies. It's best to think of a RAIF like a submarine with watertight compartments, isn't it? Like if her compartment takes on water, say, a specific loan defaults, the risk is entirely ring-fenced. The rest of the submarine stays afloat.
That is a highly accurate analogy, yes. The RAIF law allows for multiple compartments, creating distinct parts of the assets and liabilities within a single overarching structure.
Which is the real gold nugget here, operationally speaking.
Exactly. It's a brilliant, legally robust mechanism for ring-fencing risk. But the catch, to continue your submarine analogy, is that you have to build those bulkheads into your constitutive documents before you ever launch.
So the disclosure has to reflect the architecture perfectly.
Completely. The main offering document or the specific offering document for the compartment concerned must describe the specific investment policy. Investor and creditor rights linked to a particular compartment are strictly limited to the assets of that compartment, unless the constituted documents explicitly provide otherwise in ways permitted by law.
So this disclosure is where the capital stack, the use of shareholder loans, the borrowing strategy, and the compartment logic must completely line up.
Yes, they cannot be fighting each other in the fine print.
Which leads us to another operational hurdle, depositing those assets.
Right. Under the RII law, assets must be entrusted to a depositary. But there's a vital operational carve-out here for private infrastructure designs.
Oh, how does that work?
Well, if you have a closed-ended RAIF with no redemption rights exercisable for 5 years from the initial investments, and it generally does not invest in custody assets or generally invest in non-listed companies to potentially acquire control, then the depositary does not have to be a traditional bank.
Oh, wow. So you can use a professional depository of assets other than financial instruments.
Exactly.
Which sounds incredibly helpful for illiquid long-term asset strategies where a traditional banking model might not fit. But let me push back on this whole process for a moment.
Okay.
Hearing this, the strict classifications, the meticulous document alignment, the complex RIIF compartment's legal costs must simply skyrocket with all these new rules, especially for anything labeled infrastructure.
It's a common concern, certainly, but the reality on the ground is far more nuanced. Legal costs do not automatically skyrocket just because a fund has the label infrastructure or because it originates loans.
Okay, so what actually drives the cost then?
Costs usually turn on the complexity of your specific vehicle choice, the chosen AIFM and depository model, the number of compartments you decide to set up, and the intricacies of the intercreditor package.
So unnecessary complexity drives the cost, not the sector itself or the new regulation.
Precisely. If a structure is elegantly designed from the start, it remains entirely manageable. Now, while we aren't diving deep into tax today, any elegant design must factor in debt versus equity characterization, transfer pricing, and cash repatriation across the chain.
Sure, which require careful analysis of the full fact pattern.
Exactly. But again, that is standard, prudent practice, not a punitive new regulatory cost.
That makes a lot of sense. But even with an elegant playbook, complex capital stacks always create friction. Let's talk about the specific regulatory traps or failure modes that teams are going to stumble into. For instance, the 150% threshold. It seems like a highly subtle operational trap because it does two completely different things, right?
It absolutely is a trap if your compliance team isn't tracking it correctly. The 150% carve-out appears twice in the statute, doing two entirely different jobs.
Okay, walk us through that.
First, the law states that mandatory credit policy and portfolio monitoring requirements do not apply to the origination of shareholder loans if their aggregate notional value does not exceed 150% of the AF's capital.
Okay, so that is an exemption from the administrative and policy side.
Right. But then the exact same number appears again in a different context. This statutory leverage cap does not apply to a loan originating AIF whose lending activities consist solely of shareholder loans, provided again their aggregate notional value does not exceed 150% of the AIF's capital.
Wow, so you have a single threshold that provides an exemption from administrative policies on one hand and an exemption from leverage limits on the other. You really have to monitor it simultaneously for two completely different regulatory reasons.
You do. And missing it on either side has significant consequences.
What about concentration limits?
The law establishes a strict ceiling to prevent systemic contagion. Loans originated to a single borrower may not exceed 20% of the AIF's capital, specifically where the borrower is a financial undertaking, another AIF, or a UCIs, which is an undertaking for collective investment in transferable securities.
The reasoning there being that if a financial borrower defaults, they don't want it taking down the fund and spreading risk throughout the broader financial sector.
That is the exact systemic risk they are mitigating, yes. And speaking of risk, if you do not fall under that shareholder loan exemption we discussed earlier, your leverage is strictly capped.
What are the limits?
The limit is 175% for an open-ended loan originating AIF and 300% for a closed-ended one measured by the commitment method.
Let's talk about that for a second, because that open-ended versus closed-ended distinction seems massive. A lot of teams probably assume they can just roll out an open-ended structure because that is what their investors are used to, but under this new law, that's a dangerous assumption.
It is a profound mistake. Under the new rules, closed-ended is the strict statutory default for a loan originating AIF.
Oh, really? It's the default?
Yes. If you want to structure it as open-ended, the AIFM must proactively demonstrate to the CSSF that the fund's liquidity risk management system is genuinely compatible with its investment strategy and its redemption policy.
So if you mistakenly try to launch an open-ended fund without proving your liquidity management is absolutely ironclad, the CSSF is going to halt you in your tracks.
Immediately. You have to prove you can handle the liquidity demands of your investors while holding highly illiquid originated loans. And another major trap involves acting as a mere conduit.
What does that mean in this context?
Well, the law requires member states to prohibit strategies that originate loans with the sole purpose of transferring them to third parties.
So you cannot just be an originate-to-distribute machine, which I assume is to stop managers from originating poorly underwritten loans and immediately offloading the risk onto unsuspecting buyers.
That is precisely the moral hazard the EU is eliminating, and it ties directly into the retention rules.
How so?
To ensure you have skin in the game, the AIF must generally retain 5% of the notional value of each originated loan that it transfers to a third party.
Right.
If you try to transfer 100% of that loan onto the market, you are in direct violation of the law.
Wait, hold on. Let me stop you there and clarify something about our definitions. I want to make sure I completely understand the separation failure we touched on earlier. We talked about how a shareholder loan cannot be separated from the equity. Are you saying that even if my fund owns the holding company entirely, I cannot just spin off that shareholder debt to a third-party buyer if my fund suddenly needs quick liquidity?
That is exactly what it means. Trying to decouple them selling off the debt to raise cash while keeping the equity stake is a fundamental breach of the shareholder loan definition. The moment you separate them, it ceases to be a shareholder loan, and you lose all the regulatory exemptions tied to that classification.
That is a massive constraint on liquidity planning. You are truly locked in. Are there any other traps?
Well, the final major failure mode seems to occur right at the starting line. It's the mismatch at first signing.
How does that happen?
This is unfortunately quite common. It happens when the compartment disclosure in the offering document and the actual lender's security assumptions contradict each other after the fund has launched.
Right, going back to what we discussed about alignment.
Yes. If the legal architecture isn't perfectly aligned on day one, unwinding it after capital has been deployed is an absolute nightmare. The ultimate fix for all of these failure modes is relentless discipline at inception.
So, to avoid these points of friction, what tangible steps should you, the listener, be reviewing right now? If you're sitting at your desk, what is the checklist?
Number one is your credit policies. AIFMs must verify they have implemented effective, documented policies, procedures, and processes for credit risk assessment, as well as for administering and monitoring the credit portfolio.
And these can't just be boilerplates, right?
Absolutely not.
Yeah.
These cannot be generic templates that sit on a shelf. They must be bespoke to your strategy, kept up to date, and formally reviewed at least once a year.
Okay, so that's policies. And second on that checklist would be disclosure checks.
Yes. Verify that your RAIF offering document or the compartment-specific document includes all necessary information for investors to make an informed judgment on the risks attached to the capital stack. Transparency is not optional here. It is a strict regulatory mandate.
Right. And finally, those mathematical audits we talked about. Your compliance teams have to be actively monitoring the math. They need to track the dual 150% carve-out thresholds for shareholder loans, monitor the 20% concentration limits if you are lending to financial borrowers, and constantly assess the 175 or 300% leverage caps using the commitment method.
The numbers must be rigorously, continuously tested. This is an ongoing operational commitment, not a one-off check.
Now, a crucial question for transaction planning. What is the timeline for compliance? What are the specific dates from the law that matter for the calendar?
There are 4 strictly fixed dates derived from the text that you must track. First, the general entry into force of the Luxembourg law is the 16th of April 2026.
Okay, so that is the baseline date the whole new framework goes live.
Correct. Second, there is a deferred entry into force specifically for Articles 16 and 42, points 1 and 2, under the adopted text.
And when is that?
Those specific articles enter into force on the 16th of April 2027. So you have a 1-year deferral for those specific points.
Got it.
Third, looking further out, the 16th of April 2029 marks the end of the main transitional period for certain pre-existing loan-originating AIFs under the directive.
But there is a backward-looking date that is absolutely critical here, isn't there? And it's entirely unbending.
Yes, and this requires exact attention from every structuring team. The 15th of April 2024.
2024.
Yes. AIFs that were constituted before the 15th of April, 2024, and that do not raise additional capital after the 15th of April 2024 are deemed to comply with certain transitional safe harbors regarding leverage and credit policies.
The 15th of April 2024, not the 16th. If you raise capital one day later, you lose those safe harbors.
Exactly. Moving that cutoff date to the 16th would be legally incorrect based on the directive. It is a strict line in the sand, and it completely determines which regulatory regime applies to your existing funds.
Well, in the end, this framework proves that while good fences might make good neighbors, precise statutory definitions make for highly bankable fund structures. By replacing informal supervisory practice with clear, unyielding legal boundaries, Luxembourg offers transaction teams the exact certainty they need to build robust, compliant credit architectures.
I couldn't agree more. The certainty is ultimately a huge benefit to the market.
Follow on Spotify or subscribe to Rigor Media and Bertrand Muraux on YouTube. Connect with Bertrand on LinkedIn. Visit bertrandmurillo.com. All links are in the show notes. It was the Luxembourg Fundcast for you today.